Okay. Thought I'd take a chance to make another video real quick, just in response. I've been answering some questions for one of our students, Kim. Excited to be able to help you out here. The idea, the little video we made yesterday, was based off of a real quick. I just grabbed Ford out of a hat. Like I just picked it out of a hat. I didn't have any real specific love for the stock. The reason I picked it. As a quick one was just the first one that came to my head that was low price stock would be a good one to practice on. And general idea was that it was trading. It had traded down into a known support resistance neighborhood, just ballpark. And I had drawn a little primary, little trend line off of some pivots in that ballpark, and it's down here after earnings. And you go look at their earnings report, and they met their earnings expectations. They do pay a dividend, which is for the price of the stock a very lovely percentage. And it's, after their earnings it had a gap, and the selling has been kind of tapering in volume, so we're not seeing real heavy selling, and I'd probably even consider this kind of a falling wedge, so to speak. And the expectation is that we do get an upward movement in price, and so we structured a bracket order, which you can actually see here. So the bracket order, and the first question, let me go to the follow-up email real quick here, is one, do we set the entry price using a buy stop limit above the asking price to receive upward confirmation? You're pretty sure the answer is yes. Well, yes, that absolutely is correct. We want to set a buy stop because what it does is it confirms support. So it's right now this is currently running down, and we identified a potential buy zone, and I don't think it's going to dip much below 14-ish. To put it into perspective, we can change time frames and drop down into, say, a 30-minute time frame. And what we see is you're still in a downward trend. So where we set the buy price yesterday was so it would clear previous day's high prices. And you'll see the stop price is we set it at 1440 for the stop to guarantee that it traded above 1440. And a limit of 1445. So I had to trade above this line crosshair right here, 1440, but won't spend more than 1445. So it just confirms that upward movement in price. And because it is still in a downward trend on this time frame, entering the trade early in attempts to get the better price, you're basically buying something that's still depreciating. It's still in a downward trend. And so until we see a reversal of downward trend here, we're seeing lower lows and lower highs. We don't want to buy until we see it reverse and start making higher highs. And so it's, the idea is like you don't want to try and catch a falling knife or a falling piano because the current direction of trend as far as day traders and short-term swing traders goes is down. And so we just don't want to guess where the bottom is. And so that actually answers, I think, your second question. So you get entering above the asking price is confirming an upward trend. What you don't understand is why I wouldn't pay the lower asking price at 1431 and use a trail stop for an upward confirmation. So you can get in and also, set it and forget it. I think you want to buy low, and this is actually kind of a general consumer mindset. And this is the exact same thing I struggled with early in directional trading, is the idea of, well, okay, let me drop it back out to the daily time frame. In theory, I know that this is a support zone. Like old resistance could become new support. And the problem with that is we put too much stock, no pun intended, into that idea. That old resistance should become new support. So, when I first started learning to trade, I would go identify support and resistance zones, and just because I identified a pivot here and drew a line on my chart led me to believe that that was a physical barrier almost, that the stock it had to go up because that was support. The books told me that old resistance would become new support and that it should come down here and automatically should go up. And so if I could just get down here at the best price, then I would make more money. And there's a certain logic to that, but it's counterintuitive to, and one of my first mentors, Jeff Crystal, he literally slapped me in the back of the head and he said, Noah, it's going down. And what would happen to me is I'd get in thinking I'd get the best price, and it would keep going down, hit my stop loss, And then eventually it would find support and turn and pop back up. But I was getting in, and it's kind of like standing in front of a, if this is the bus stop, and I'm standing out here in front of the bus, and I'm hoping that the bus that's coming to pick me up there, that's not a very good octagon there, but there's a bus stop. That bus is coming towards me, big old bus coming towards me. Here's a bus driver. You're hoping that it stops and doesn't just hit you, because it's the momentum, the forward momentum here, carrying you forward. It's going that direction. So we just don't want to stand and try and predict where support's going to form. So that's why we wait for it to go up, which means we will pay more. And the question is how much do we want to pay? So one of the first indicators that you'll learn is like a stochastic indicator. And a stochastic indicator, if we were to go pop one on a chart, it uses a pretty funny little formula, but it actually makes a little bit of sense. If we were to go to indicator here and go add stochastic, go put on a full stochastic, and it's got these little lines on here where if it's down below 20, it's oversold, and if it's out above 80, it's overbought, and the scale goes from 0 to 100, and you're like, well, okay, oh, that means percent. And what this indicator is tracking is this one's set to 10 days. So it's tracking 10 days. It's using a 10-period moving average of the 10 days. So the red line's tracking 10 days of closing price. And what it's trying to figure out is, over the last 10 days, what's the highest high price minus the lowest low price, and then it's divided by the last rate of price. And you can actually look at the formula here, and it's trying to express this into percentages. So basically what it's saying, well, is the last 10 days, the highest high price is out here, the lowest low price is out here, and we're currently trading down near the lowest low price. And if it goes up 20%, that's enough confirmation to buy. If it runs up, and goes down 20%, that's confirmation to sell. And so what it's trying to identify, it was originally written for commodities that would oscillate. The charts would go like this, because the price of corn didn't vary that much. And the gentleman who wrote it, George Lane, was trying to catch the bottom, and he was giving up 20% to know that that was support. And when it got up to the top, he was giving up 20% on the top to know that that was resistance. And what he was after was the 60% in the middle, what we know as the zone. So that's the idea behind it. Now, one of the questions is well, is 20% enough, or is it too much? And so, my answer to the question is, well, it's the indicator's a loose way to do it. If we were to go in and simply use candlesticks, this is one of the reasons we love a doji candlestick, is because the doji candlestick is small, and we put an entry above it, and then a stop loss down below it, and we have a small risk profile. Now that the price has continued to go down, the high price I needed to take out has lowered, so we can lower our stop limit. The best way to do it is to actually cancel and replace the order, but we can just drag it down and kind of ballpark that above that candlestick high and send that in. And we could then lower the trail stop too, and we kind of lower the whole trade down. So now we've kind of got the trail stop down there, and we've got the target out there, so we've kind of got the whole thing now. That's the reason we do that. So that's the question is why do we wait for it to go up? Just to make sure that it's changed directions and it's formed support. So the general idea is we think it's going to be support, but it's not support until it goes up, and it's not a pivot until it trades above the previous candlestick high. So it's got to take out a candlestick high. And a simpler way of thinking about that is to change time frames. Whoops. Let's change time frames and go look at it for the last, we'll go look at it for the last 20 days and 30 minutes or so. And what we'd be looking for is a reversal pattern like a W or an inverted head and shoulders. How do I know when it's done going down? Well, you don't until it goes up. And so we're basically waiting for this intraday downward trend to head back up or the last 180 days, drop it to like a 2-hour time frame. We're asking for a lot of data there, so that'll take a minute to pop up. But I'm waiting for the current downward day swing trading trend to concede to the larger price zone, the larger trend, the little trend line I drew on the bottom of the chart, for it to actually reverse and start to go the same direction. It's kind of a confluence of trends. So I want my day trader trend and my swing trader trend to match the reversal pattern. So here, the fact that it broke to new highs is one of the things I like. Now this is kind of hard to see because it had like a one shot down here during that one crazy day in August, but the open and close kind of put, that's where I drew the little trend zone, was right in here, and it coincided with the support and resistance zone here. But there's another little scenario going on here where it broke to a new high. So before it was going lower low, lower high, lower low, lower high, lower low, and it broke to a new high, boom, there's a W. And when it breaks to a new high, that's the first wave into an Elliott wave. And when it retraces, it shouldn't retrace more than, say, 61.8%. And if that's the case, that's a perfect little setup for the next run. And we're hoping that it gets out there. So the reason that I set that up that way is just based off the fact that it went on sale, and it's, you know, it's okay. So now let's drop that back out to a daily time frame. And to answer, I think, the last question you had here. Whoops. I think I accidentally closed your... let's see here. Okay, so that's to answer why we place that order to get above that. Now, to choose the buy stop limit price, I find day high price data window, and you add that, feel comfortable. But really, it's okay. Let me give you one other thing you need to understand here. What we're after here is swag. Swag stands for scientific, wild, bleep, expletive, get. Okay, sorry, the recording got briefly interrupted. We were looking for swag, scientific, wild guess. We're just ballparking it. It's easy to suffer from analysis paralysis here. You don't want to overthink it. So really what we're looking for is to make sure that it's changing directions. We're looking for it to give me a reversal pattern intraday, and I need to make sure it's not just coming up and hitting it or getting close to it. We want to make sure it's really changing directions. So something that might help with this idea is, I'm going to grab a little whiteboard here. Markets have changed in the last couple of years because of some of the automated trading computer systems. And so, you know, a typical setup would be like a bullish retracement where we expect prices to come down. We're watching for small body candles like dojis. The reason that we see those is consistently, if we were to take this and look at it under the microscope, what that is it's an upward trend followed by a downward trend intraday. So for the intraday traders, it's higher highs and higher lows. It reverses, lower lows and lower highs, and it usually puts in slowing momentum and then reverses. And that's why you get small body candles, is that the price action slows down. You see that big drop, less of a drop, less of a drop, less of a drop. And it was really, really common to get very, very clean entries on stocks where you'd have, like, you know, nice little doji or spinning top or something like that, and it was easy to put in an entry above it and a stop loss right below it. But what started to happen is it would trigger and whipsaw and kick us out of the trade, and it created a lot of frustration. You get stopped out a lot. So it forced us to use looser stop losses. And really what's happening is the intraday chart is still doing the slowing momentum, but then it hits what's called an alligator pattern, which is increasing volatility, which is kind of more like a fist fight. And we call it the alligator pattern because it looks like a little alligator here. That the trading programs were written to hit the triggers, and then it would whipsaw on purpose. It would actually front run, and it would take out trader stop losses, and then it would hit that again. I mean, it was designed to take trader stop losses out. It was a way for them to scalp and make money. So it just forced us to use looser stop losses. And so as a general rule, when I'm doing bullish retracements, the problem I have is it's running down. And so when you're entering in, we're hoping that as that upward trend is coming down, and we're watching that little intraday reversal come and take off, we're waiting for it to turn to get in to avoid the downward movement, that momentum from carrying through. So that's why we do the confirmation. And where we used to be able to just put below candlestick lows, it's forced us to use looser stop losses. So 1.2 ATRs, 1.5 ATRs put you further away. And so let's take that alligator and let's put the alligator here on a chain. So we got a hungry alligator. And that alligator here is on a chain that is the distance of the ATR. So the ATR in this case was 0.29 cents. So I've got an alligator, hungry alligator, on a 29-foot chain. Well, if I got a 29-foot chain, let's round it up to 30, a 30-foot chain, and that's staked into the ground there, how close to me do you want to stand? How far away do you need to stand so the alligator doesn't come get you? Well, statistically, you got to be beyond 29 cents. So if you can get out here, at 33 feet away, you're just outside of its statistical reach, but that doesn't mean it can't break its chain or restraint and still come get you by doing something more than the average. So the best thing we could do is actually have a fence or a wall between us, which would be a form of support or resistance. So if we could have a brick wall between us to be beyond an ATR and behind a support protection zone, that helps improve our odds. If you get stopped out too much, your stop losses are too tight. You need to start keeping track of your trades and discovering how frequently you're getting stopped out and how frequently you're getting the trades right, et cetera, et cetera. And so you start to figure out, well, if you're getting stopped out often, your stop losses are probably too tight. So for now, 1.2 to 1.5 ATRs, a volatility stop of 2 ATRs is just a good loose distance away, and it's a great way to stay into trades, because the challenge you'll run into is markets these days, the way that support forms, it kind of whipsaws a bit. And so you can look at the stock's personality for clues. And, if we go look at Ford's personality, they're pretty clean transitions. No major whipsaw transitions. So we could probably get away with that. And so let's see what we've got here on the order right now. It looks pretty good with the way we've got it. We got a trigger, and let's go intraday again. Let's drop that down into, let's go down here, last 20 days, and we'll hit 1 hour. The trigger I've asked for is for it to clear that resistance high, which is around 1439. So I've got a stop limit lower down to 1440 by 1445. So 1440 stop, that's the trigger. 1445 is the limit, to make sure we don't spend too much. And then we've got the stop loss down at 49 cents off the base, so it's going to be down at about 13.37, so that puts us down below 14 bucks. That's good distance away. It's more than 1 ATR. And then a target of 15.50 for half the shares. So we're selling, the reason we're selling half of the shares, which is your other question. So the other reason we have that is, let's see if we got that here. Let's see here. We want to go make sure it's triggering, but we don't want to spend too much. So that gets us a confirmation. I'm speaking about risk, typically needing 1.2 to 1.5 ATRs. We want to go loose. Loose just means further away from the hungry alligator, just standing clear, so it doesn't hit you. If I'm going to step into the ring with Mike Tyson, my goal is to stay outside of his reach. Let's see, in the sell limit, 50% of the shares, that's just scaling out. It's just a way to lock in a profit and to let half of it run. So if we could, take half of that as a profit, because I actually think that seasonally we should still be bullish. I think also that this is I think I mentioned this, but I can't remember if this was part of the got cut out, that we have a reversal pattern. So it was, lower lows, lower highs through here, and broke to a higher high. That's a first wave. And if it's a correction here, it shouldn't dip down more than 61.8% of that first break. And that would set us up for, that's a second wave drop, and then that could be a third wave run, which could be a big one, which might get us back out to the highs. It might run up through the end of the year. I mean, we don't know. But if I can, get half the shares off the table by the time it fills the gap, then I have 100 shares free and clear, not free and clear, but with very reduced risk, nice profit, nice cushion, get paid get paid now, and let it run. And I still have 100 shares off of which I could then write covered calls, etc., etc. So hopefully this was helpful for you. And that as you're practicing, just practice, practice, practice. And I think the best advice I could give to you, Kim, is just don't be afraid that you're doing anything wrong, because there really is no right way to do anything. There's no any specific exact way. It's really just kind of like what's more effective and less effective. And in your own trading, practicing the virtual trading and keeping a good trading journal will help you figure, some of the trial and error and help you find your own style. And, if there's anything else I can do to help you out, let me know.